Hello and welcome to the latest instalment of WAM Vault. My name's James Marley, I'm your host, and today I'm joined by Oscar Oberg and Tobias Yao, who are the portfolio managers of Wilson Asset Management's micro and small cap strategies. Oscar, I'm going to start with you. I understand you're bullish on the outlook for the Australian economy. Could you give me an insight into what's driving that optimism?
Yeah, given how well, James, that Australia's managed COVID, and I guess what we're seeing with low interest rates, record house prices, it's really hard not to be bullish on the Australian economy at the moment. I mean, Tobias and I have seen hundreds of companies really in the last 2 or 3 months, been across Australia, and it really is a very positive and buoyant picture for corporate Australia going forward. And I think that one of the best examples, I caught up with a non-bank lender, one of the largest in Australia, just yesterday in Melbourne, and they were saying that the number of problem or impaired loans that they have in their book is actually lower today than what it was before COVID. So it just shows you how strong the Australian economy is right now.
So with that positive backdrop, what sectors do you think are set to outperform?
So we've certainly played the transition from growth to value, and we did that as soon as the announcement around the Pfizer vaccine occurred back in November. We've positioned the portfolio in sectors such as financials, diversified financials, and then some other what we would call beaten up sectors, I guess, the most impacted sectors and companies from COVID. And these are sectors such as aged care, construction services, building materials, and we see a really buoyant outlook for these companies, particularly for earnings growth over the next 2 or 3 years.
Mm-hmm. Small caps have had a really strong period. What's your outlook for the smalls?
Yeah, very bullish, James, still are. I think it's a great period for small cap investing, probably one of the best we've seen. Great for our investment process as well. And that's largely because around 40 to 50% of the small cap companies that we look at are exposed to the economy in some way. Now, we have shifted our thinking. When we talked 6 months ago, we were very bullish on sort of retail and automotive and agriculture. We have shifted to more cyclical and cheaper sectors, such as financials, mining services, etc. And we do think that these sectors will outperform sort of over the medium term.
And in terms of that small space, have you got a tilt for size? Is it smallers or mid caps? Is there a sweet spot there?
The strategy really hasn't changed since this time last year. We wanted to stay in more liquid companies, bigger companies. So I think the average size of the companies that we invest in WAM Capital is around $3 billion. We could probably sell around 80% of the portfolio if we wanted to in 5 or 6 days. So look, we're staying liquid. It's a very volatile market. It changes every week. It changes every day. It goes from growth to value. So we're happy staying liquid, and it's still an uncertain market. Who knows? We might have an outbreak of COVID. Touch wood. But at the moment, we're happy with how we're positioned like that.
Okay. Well, the reopening trade's been one that people have been really focused on. Sectors like housing, travel, media in the spotlight. Why don't we go through a few of those sectors? Oscar, I'll kick it off with you. Got a view on housing?
Yeah, very bullish housing. Sam, who's in our team, did some great work when the home builder scheme got announced just over a year ago. It's about $100 billion, and effectively that's the equivalent of 12 months of new housing construction in Australia. So it's just massive. So, the building materials have been a good space for us. We still hold, we've got big holdings in Fletcher Building, Adelaide Brighton and Reliance worldwide. And we've also got those financial companies exposed to the housing market. So that'd be like a Gemworth or an Australian Finance Group.
Travel space, we're all still waiting to find out if we can go offshore, but domestically travel's been really strong. How are you thinking about that particular part of the market?
Yeah, we're really bullish travel. So we've been adding to our positions because it does actually feel like sentiment to the travel industry right now is the lowest, we think, since the vaccine got announced in November. And I think that's because we have been slow in Australia to roll out the vaccine. But people have forgotten, before COVID hit, using Flight Centre as an example, over 50% of their earnings came from the US and Europe. And we're about to go into the European and US summer. And there's been a lot of quotes from tourism companies globally. And the best one we saw is Hilton, who said their bookings in the US are up 10%, comparing that to the pre-COVID period going into the summer. So we do see high levels of pent-up demand, and we do expect once we get back to normality, a lot of that money that's gone into the retail sector will come back into the tourism sector.
Tobias, the other sector we're going to have a chat about was media. What are your views on the space? It's had a bit of a revival and a renaissance.
So we're definitely bullish the traditional media sector. We have holdings in Seven West Media, which is the old Channel 7. Media, which is a large outdoor media company, and also Here, There and Everywhere, which is the old Australian radio network. Now, coming out of COVID, we believe companies will have to spend aggressively to try to re-establish their brand presence in the market. And if you add the additional ad spend that's going to go into the next federal election, our view is that over the next 12 months, it's going to be a very buoyant ad market, and that's going to directly benefit the three players I mentioned earlier. The other common thread between all these players is they all have their firm-specific catalysts. So for Seven West Media, it's about divesting and deleveraging. For Media, it's about rolling out a cost-out program under the new CEO. And for Here, There and Everywhere, it's about crystallizing the value of their minority stake in a high-quality software business.
Okay. Now, Oscar, last time we caught up, we talked about agriculture, and it was a part of the market that you were pretty bullish on. Could you give me an updated view on your view across that sector?
Yeah, we're still positive, James, but we have shifted our focus, I would say, in terms of the companies that we quite like at the moment. So GrainCorp and Elders are still in the portfolio, but they're at a lower weight, and that's largely because we think the conditions we're seeing seasonally across Australia is as good as people have ever seen it. So we have transitioned more into some of those agricultural stock exposed to a reopening style trade, and United Malt Group's an example of that. It's one of the largest malt processors globally. It's exposed to effectively a reopening of restaurants and pubs in the United States. So we think they're going to go well. And also Select Harvest, which has been a business that's been impacted by very low almond prices for some time. There's a drought in California. California is the biggest producer of almonds. So we do see the potential that almond price starts to lift over the next few years. So it's an early call, but we quite like that one.
Now, Tobias, it's hard to pick through the market and find those stocks that may not be grabbing the attention. Have you got a few ideas of parts of stocks or ideas that you think are being a bit overlooked at the moment?
Yeah, so I have three ideas, all of which we've gone substantials in recently. The first company is Virtus Health. It's actually the leading IVF clinic group in Australia. We bought the stock around a year ago on the recovery trade, but our current investment thesis is premised on the new CEO's ability to find new revenue streams. So this is in precision fertility, in genetics testing, and in also digitization services that they can use for companies overseas. It's trading on 14 times price to earnings ratio, so we think a lot of these additional optionalities not being priced into the current share price. The other company is Ardent Leisure. Now they own Main Event in the US, which is like Dave & Buster's, they own family entertainment centers. They also have a theme parks division here in Australia. Now the US recovery is actually going really well on the back of strong government support for the consumers and much more relaxed COVID restrictions that's currently in place. Our view is that at the current share price, you're not paying anything for the theme parks division, which is over $100 million on the balance sheet. So the risk-reward trade-off for this one is really appealing for us. And the final company is Lynch Group. It's a recent IPO, but it's actually a business that's been around for decades, and it is the number one floral supplier in Australia. We think this is a value company, a growth company priced on a value multiple, and the market currently underappreciates the medium-term growth drivers for this business. So it's on 11 times PE. We think there will be earning upgrades and perhaps a couple of inorganic M&A opportunities over time.
Well, Oscar, it's been a really bright spot in the market, the small caps. What message would you give to investors about the opportunity in the micro and small cap part of the market going forward?
Yeah, there's a lot of commentaries. I think because the market's up a lot since this time last year, and people saying, "Oh, the market's too expensive. Now, we'd agree with that with certain pockets of the market, and certainly, what we've seen with technology companies, healthcare, biotech, they are expensive, no doubt about it. But I think there's, on the other side of the spectrum is there's a lot of cheap companies out there, and you just got to find them. And a good example is Seven West Media, which we own in WAM Capital, WAM Microcap. I mean, that's trading on a price earnings multiple ratio of 3.5 times earnings right now. Like, it's less than half of what Channel 9 trades on. So, like a company like that, that's sitting right now in our wheelhouse, and it's a company we like to invest in. So we're seeing plenty of opportunities. We're seeing plenty of companies with catalysts. And so for that reason, we're very bullish small caps and micro caps going forward.
Okay, well, Oscar, Tobias, great to catch up. Thanks for your time today.
Thank you.